Welcome back to the deep dive, and today we are doing something a little bit distinct, a little specialized. We are calling this edition Griffonomics.
I like the ring of that.
It has a certain weight to it, doesn't it?
Yeah.
It is Wednesday, February 11th, 2026. And if you are listening to this and you happen to have a financial news terminal open, or maybe you just glanced at your phone notifications this morning, you might be looking at the screen with a very confused look on your face.
It is definitely one of those mornings where the numbers on the page and the reaction of the market seem to be living in two completely different parallel universes.
Completely. So let's set the scene for everyone. We are talking about Smurfit Westrock today, ticker symbol SW. They just dropped their Q4 2025 earnings report. And usually dropped is just a figure of speech. In this case, it feels like they literally dropped a lead weight on the table.
It was heavy. And not in a good way, at least not at first glance.
On paper, this report looks like a crime scene. I mean, we're talking about a massive miss on earnings estimates, a 64% negative surprise.
64%, that's not a rounding error.
Not at all. Revenue is flat, volumes are down, and yet, I'm looking at the pre-market trading right now, the stock is up. It jumped 5%.
It's the classic earnings paradox. It's the kind of thing that drives day traders absolutely insane and makes long-term investors lean in and, squint at the screen a little.
So the core question, the Griffonomics question we are tackling today is pretty simple. How does a company miss the mark that widely, yet win over the market instantly? Because usually, let's be honest, if you miss earnings by 64%, you get taken out behind the woodshed.
Usually, yes. You get punished. Yeah. Hard. The algorithm traders would just sell without even thinking.
Exactly. So why the applause this time? Why the pop?
Because the market is a forward-looking machine. It's not looking at yesterday's weather. It's looking at tomorrow's forecast. And what investors saw this morning wasn't just a messy quarter. They saw a pivot, a fundamental transformation from what we might call an asset accumulation phase, just getting big for the sake of being big, to an optimization phase.
Optimization. That sounds like polite corporate speak for firing people and closing factories.
Well, to be fair, it often is exactly that. But there is a specific, very disciplined strategy behind it that Smurfit Westrock is pushing. They call it value over volume. And that is what we are going to unpack today. Because if you understand value over volume, you understand why the stock is up 5% despite the ugly headline numbers.
Okay, value over volume. It sounds catchy. It sounds like something you'd see on a motivational poster in a break room. But we need to see what that actually looks like on the ground, in the mud, where the boxes are actually made. So here is our roadmap for this deep dive.
Lay it out.
First, we are going to look at this kitchen sink quarter. We need to explain why the numbers were so bad and why, paradoxically, that's actually a good thing. Then we are going to look at the massive turnaround happening in North America. They are shedding billions, literally billions of square meters of business.
Which is a bold move. I mean, it really takes guts to do that.
Incredibly bold. We'll talk about the cultural revolution they are calling the owner-operator model. And then, and here's where it gets really interesting for the folks who like to look for hidden treasure maps, we are going to talk about a hidden free option involving a $70 price hike that nobody is fully counting yet.
That is the cherry on top of this whole thesis. That's the free option.
And finally, we'll look at their 2030 plan to reach $7 billion in EBITDA. So buckle up. Let's start with the mess. Section 1, the earnings paradox. Talk to me about these numbers. Just how bad was the miss?
Well, let's look at the expectations versus reality. Wall Street, the analysts who are paid to predict these things down to the penny, they were expecting earnings per share, or EPS, of roughly 50 cents.
Okay, 50 cents. That was the bar, the consensus.
That was the bar. Smurfit Westrock came in and posted 18 cents.
Ouch. That is not just a miss. That is a whiff. That is swinging at the ball and hitting the catcher.
It is. And revenue was $7.58 billion, which is virtually flat year over year. So you have flat sales and just plummeting earnings. It's a combination that normally spells disaster.
So if I'm an algorithm, and let's face it, most trading is done by algorithms these days, I'm reading that headline and I'm selling immediately. No questions asked.
Immediately. The algorithm sees miss, down, bad, sell. But the human investors are digging deeper. They are reading the footnotes. They are listening to the conference call. They are asking why they miss. And the answer isn't that they couldn't sell boxes. It's that they chose not to produce them in a way that would pad the numbers.
This brings us to a specific term I saw in the report, economic downtime. They took an $85 million hit in Q4 for economic downtime. Now, to me, downtime means I'm sitting on the couch watching Netflix. What does it mean for a massive industrial packaging company?
Sure. Let's go back to Physics 101 for paper mills. These are massive capital-intensive beasts. They consume huge amounts of power, water, and labor. They're designed to run 247, 365 days a year.
Because they're incredibly expensive to build, so you want to get your money's worth right. You don't want them sitting idle.
Exactly. The old school mentality in this industry is run them full out. Make as much paper as possible.
Yeah.
Because the more tons you produce, the more you can spread your fixed costs. Your mortgage on the factory, your salary staff, your insurance over those tons. It lowers your costs per ton.
Right. I remember this from business school. If I pay $100 in rent and make 100 cookies, my rent cost is $1 per cookie. If I make 1,000 cookies, it's 10 cents.
Precisely. So usually managers want to make 1,000 cookies, even if nobody wants to buy them right now. They just stack the cookies in the warehouse to make the cost per cookie look good on paper for that quarter.
But then you have a warehouse full of stale cookies, and you've tied up cash and all that flour and sugar.
Exactly. And that is the key. You tie up working capital. What Smurfit Westrock did in Q4 was proactive. They looked at their inventory levels and said, we have too much. We are not going to play the volume game just to make the quarterly numbers look pretty.
Yeah.
So they shut the machines down.
They just turned off the oven.
They turned off the oven, but they still had to pay the rent on the bakery. That cost, that unabsorbed fixed cost, is the $85 million. It hits the earnings directly. It makes the quarter look terrible, but it means they aren't building up excess inventory that they'd have to discount later just to get rid of it.
So they took the pain now, that $85 million hit, to avoid carrying dead weight into 2026.
Precisely. It clears the decks. It's what we call a kitchen sink quarter. You throw all the bad news, all the costs, all the cleanup into one quarter so that when Q1 2026 starts, you have a clean slate and a lower baseline to grow from. New management loves to do this.
And that explains the North American volume drop too, right? I saw a corrugated volume drop 10.5% in North America.
Yeah.
That is a double-digit decline. That's a scary number in isolation.
It's a terrifying number. In a normal growth story, a 10.5% drop in sales is a disaster. It means customers are fleeing. It means your product is wrong.
Yeah.
But in a restructuring story like this one, that 10.5% is actually evidence of discipline.
Evidence of discipline. That's a fascinating way to frame a drop in sales. We sold less and we're proud of it.
It sounds counterintuitive, but think about it.
Yeah.
If you are selling a product at a loss or at a razor-thin margin that doesn't justify the machine time, every time you make a sale, you are losing money or, at best, breaking even. The disciplined thing to do is to stop selling it. And that leads us perfectly into Section 2, the core strategy. This whole idea of value over volume.
Okay, value over volume. Let's dig into this. Because that volume drop, that 10.5% drop, wasn't an accident. It wasn't because the phone stopped ringing or the economy fell off a cliff in Q4.
No, it was entirely deliberate. You have to remember the context here. Smurfit Westrock is a new entity. It's the result of a massive merger between Smurfit Kappa, the European giant known for its efficiency, and Westrock, the American giant.
Right. And mergers are always messy. You're trying to combine two different cultures, two different IT systems. It's a headache.
A massive headache. But when the Smurfit team, who were known for being incredibly efficient, almost ruthless operators, popped the hood on the legacy Westrock assets in North America, they found a lot of, let's call it clutter.
Clutter, like physical clutter or financial clutter.
Financial clutter. Unprofitable business. Westrock had been operating under that old model we just talked about, keep the machines running at all costs. So they had a book of business with customers who were buying boxes at prices that, once you factored in the cost of the mill, the transport, the labor, and the energy, were actually losing the company money.
So they were busy, but they weren't profitable. It's the classic, we lose a little on every sale, but we make it up in volume joke.
Except it wasn't a joke, it was their business model. They were chasing volume, just keeping the score up on the revenue line. So in 2025, the new management team came in and executed a purge. They deliberately shed 1.2 billion square meters of business.
1.2 billion square meters. That is
Yep.
that is a number that is hard to wrap your head around. It just sounds impossibly large.
It's massive. Let me give you an analogy. Imagine you run a trucking company. You have 100 trucks. You are running them 24/7. You look successful because your trucks are everywhere, the yard is always busy. But then you look at the books and realize that 20 of those trucks are driving routes that cost you more in gas and driver wages than the customer is paying you.
So you are literally paying the customer to ship their goods.
Effectively, yes. You look busy, your revenue numbers might look big, but you're burning cash on those 20 trucks.
So what do? You park the trucks. You tell those drivers to stay home.
You park the trucks. That's what value over volume is. It's like cleaning out a garage. You have to throw out the junk, the low-margin contracts, before you can park the Ferrari. They essentially sent letters to customers saying, hey, we love you, but here's the new price. It reflects the value we provide and our own costs. If you can't pay it, we unfortunately can't serve you anymore.
And 1.2 billion square meters worth of business said, no thanks. They walked.
Right. And that hurts revenue in the short term. It hurts volume. That's why you see the 10.5% drop. But think about what remains. The business that stays is the business that pays. You have raised the quality of your entire revenue stream. You've got rid of the noise.
But you can't just shrink to glory, right? Eventually you need to sell something. If you just fire all your customers, you have amazing margins but $0 in revenue.
And that's the absolute key. That's the second half of the strategy. It's called the replacement cycle.
Yeah.
CEO Tony Smurfit gave an update on this on the call. He said that half of that lost volume, that 1.2 billion square meters, has already been replaced.
But replaced with what? More cheap business just to fill the capacity?
No, that's the critical part. It's being replaced with higher margin contracts, better customers, customers who understand the value proposition. Maybe they need the more advanced AI-driven designs we'll talk about later. They aren't just filling the hole, they're upgrading the foundation. The remaining gap is expected to be filled throughout 2026.
So they kicked out the bad tenants who were trashing the apartment and not paying rent, and now they are renovating those empty apartments and getting higher-paying, more reliable tenants to move in.
That is the perfect analogy. And this resets what we call the margin floor. If you can be profitable with lower volume because you aren't subsidizing bad customers, imagine what happens when the volume actually comes back in a healthy economy. Your profitability explodes, the operating leverage is immense.
Okay, so that's the strategic pivot. It makes sense on a spreadsheet, but strategy is just words on a slide unless people actually do it. You have to get thousands of employees across hundreds of plants to change how they work, how they think. And that brings us to Section 3, the cultural shift, this owner-operator model.
This is probably the most intangible but most powerful part of the Smurfit Westrock story. It's the soft stuff that drives the hard numbers. It's the human element.
I read about this in the transcript. They are moving away from centralized corporate command to local accountability. Now, that sounds great, but what does that actually look like on a factory floor in, say, Georgia or Ohio?
In the old Westrock model, and frankly in a lot of large American conglomerates, decisions are made at headquarters. Pricing, production targets, hiring, it all goes up the chain. The plant manager is just an executor of orders.
They're a cog in the machine. Don't think, just run the press and hit the numbers corporate gave you.
Right. Your job is to hit a volume target. Smurfit is flipping that entirely. They're giving plant managers P&L ownership. That means profit and loss ownership. They're telling that plant manager, this isn't just a factory. This is your small business. You are the CEO of this building.
So if the plant loses money, it's on them. They can't just blame some spreadsheet from Chicago.
It is entirely on them. They can't blame corporate allocation. They can't blame the sales team in New York. If the bottom line is red at the end of the month, they have to answer for it. They own the result.
That changes behavior instantly, I would have to imagine. That's a huge shift in responsibility.
Instantly. It's night and day. Let's play out a scenario. It's Friday afternoon. A customer calls and says, I need 5,000 boxes by tomorrow morning. It's an emergency.
Okay, a rush order.
Under the old model, the plant manager says yes. Why? Because his bonus is tied to volume. Hitting that 5,000 box target makes him look good. He runs the shift on Saturday, he pays his crew time and a half overtime, he pays for expedited shipping, he hits the volume target. Corporate is happy.
But the company lost money on the order because the overtime and shipping costs were more than the profit on the boxes.
Exactly. But the plant manager didn't care because he wasn't measured on profit. He was measured on volume. Now, under the owner-operator model, that manager pulls out a calculator. He says, okay, running on Saturday costs me $5,000 in overtime. The customer is paying $4,000 for the boxes. I'm going to lose $1,000 for my plant, my P&L.
So he says no, or he calls the customer back.
He says no. Or he says, I can absolutely do it for you, but the price is doubled to cover my costs. And the customer can decide if it's a real emergency or not.
That requires a level of boldness that I feel like a lot of middle managers aren't used to. They're used to saying yes.
It does. It requires an entrepreneurial mindset. And frankly, not everyone can make that shift. We've seen the impact on headcount. They've reduced headcount by over 3,000 in the last year alone. Since the combination, it's down 4,600.
4,600 people, that is significant. That's the size of a small town.
It is. It's painful. There's no way around that. But it results in a leaner, flatter organization where decisions are made faster and closer to the customer by the people who actually understand the costs on the ground.
There was another term in the sources regarding their operations that caught my eye. Substrate agnostic. It sounds like something out of a sci-fi movie. I am substrate agnostic.
Laughs. It does sound technical, but it's actually a key competitive advantage. In this industry, you have two main religions. You have the virgin fiber religion-making paper from fresh trees. It's strong, it's premium, it looks great. And you have the recycled fiber religion-making paper from old cardboard boxes. It's cheaper, it's seen as greener.
And usually, companies pick a side. They're either a virgin mill company or a recycled mill company.
Right. They are heavily invested in one or the other. So when they sell to you, the customer, they try to convince you that whatever they have is what you need. You absolutely need virgin fiber because it's stronger. Or you must use recycled because of ESG.
It's like a car salesman trying to convince you that the sedan on the lot is better than the SUV you actually came in wanting to buy.
Exactly. But Smurfit Westrock is a behemoth in both. They have a massive footprint in virgin fiber and a massive footprint in recycled. So they don't have to push a specific paper grade. They are agnostic. They can come to you and sell the solution.
So if I'm a customer, they aren't trying to sell me what they have. They're trying to figure out what I actually need to ship my product safely and efficiently.
Right. And that creates tremendous flexibility in the supply chain. If there is a shortage of virgin fiber or the price spikes, they can pivot you to a high-performance recycled grade without losing the contract. It secures the supply chain for their customers, which is a huge selling point.
Let's talk about where this is all happening, because this isn't a uniform story across the globe. Section 4, the regional deep dive. It seems like we have a problem child and a gem.
That's a very fair assessment. The problem child, or perhaps the turnaround opportunity if we're being optimistic, is North America.
And it's the biggest piece of the pie by a long shot.
It is. $18.6 billion in sales. That's 58% of the total company. But the margins are lagging. They are sitting at about 16.1%.
Which doesn't sound terrible in an industrial business, but compared to what it could be.
Compared to what the legacy Smurfit Kappa achieves in other regions, it's low. Their goal is to get that North American EBITDA from $3.0 billion to $4.2 billion by 2030. That implies margins going well over 20%.
That's a huge jump, a 400 basis point expansion. How do they get there? Is it just by firing people and parking trucks?
No, it's aggressive restructuring of the physical assets. We mentioned the downtime, but they're also permanently closing inefficient machines. For example, they just announced the permanent closure of the paper machine at Le Touque in Quebec.
Closing a mill is a big deal. That's jobs, that's a local economy that depends on it. It's a tough decision.
It is. These are very hard decisions. But that machine was inefficient. It was a drag on the system. By taking it offline, they tighten the supply-demand balance for the entire industry, and, more importantly, they remove a high-cost asset from their own portfolio. It's addition by subtraction. They're taking a sledgehammer to their own supply side to improve overall health.
Now contrast that with the gem, Latin America.
Latin America is incredible. It's smaller revenue, about $2.1 billion. But look at those margins, 24.5% in Q4.
24.5%. That is software company territory. Why is a cardboard box company in LATAM making nearly 25% margins?
It's a mix of strong market positions. They are often the dominant player in those countries, and a very smart integration strategy. The key strategic advantage that the merger brought is that LATAM is now fully integrated with the North American paper system.
What does that mean in practice? Integrated with the paper system.
Historically, a region like Latin America might be paper short, meaning they have more demand for boxes from banana growers, avocado farmers, electronics factories, than they have local paper mills to make them.
Yeah.
They'd have to buy paper on the volatile open market, which is expensive and unreliable.
So they were at the mercy of the market price, which could swing wildly.
Right. Now, they just get the supply from the U.S. mills. Smurfit Westrock can run its massive efficient mills in the U.S. South and send that paper down to Mexico or Colombia or Brazil.
So the U.S. mills have a guaranteed high-margin customer in their own LATAM division, and LATAM gets cheap, reliable paper.
Exactly. It solves regional scarcity, and it optimizes the U.S. assets. It's a perfect synergy. It turns a vulnerability into a major strength.
And then we have EMEA and APAC, Europe and Asia-Pacific.
The resilient core, $10.9 billion in sales, 16.2% margins. And remember, the European economy hasn't exactly been booming. It's been tough over there for a while.
No, it's been sluggish. Germany is struggling. Consumer spending is down across the continent.
Yet they are outperforming peers. This proves that the Smurfit operating model works. If they can make 16% margins in a slow-growth Europe, imagine what they can do in a growing North America once they apply that same discipline and culture.
So Europe is the proof of concept. It's the blueprint for the North American fix.
Precisely. It's the blueprint. They've done it before.
All right, let's pivot to something that feels a bit more modern. Because when I think of cardboard boxes, I don't usually think of AI. I think of tape guns and dusty warehouses. But Section 5 is all about the moat, innovation, and AI.
This is where Smurfit Westrock differentiates itself from being just a commodity producer. If you just make a brown box, you are competing on price. It's a race to the bottom. I can sell it for a penny less.
Right. A box is a box.
But if you make a packaging solution, you compete on value. You're selling an outcome, not just a product.
How do you differentiate a cardboard box with data, though? That seems like a stretch.
You use tools like ShelfSmart.ai.
ShelfSmart.ai. Okay, unpack that for me. Is that a robot stacking shelves in a Walmart?
No, it's a predictive analytics tool. They have a database of over 400,000 shopper studies. They have tracked, with eye tracking technology, exactly where a human eye looks when it scans a supermarket shelf.
Wait, really? They literally track eye movement.
They track everything: gaze patterns, how long people linger, what colors draw the eye first. They know that if a box is blue versus red, or if the logo is in the top left corner versus the center, it changes the probability of a shopper picking it up by a measurable amount. They can predict how a packaging design will perform. Will it be noticed? Will it be bought before it is even manufactured?
That is wild. So if I'm a brand like, say, a detergent company or a cookie company,
Smurfit Westrock comes to you and says, look, our competitor will sell you a box for 10 cents. We will sell you this box for 11 cents. But our box, because of the ShelfSmart data behind its design, will increase your sales by 15%.
that is a completely different sales pitch. It's a whole other conversation.
It changes the conversation from cost to revenue. And brands absolutely love that. You're no longer a cost center, you're a profit center for them.
And there's another one, paper2box.ai.
Right. This is on the engineering side. It uses 50 million data points from their supply chain to engineer the perfect box structure.
Perfect, meaning what? Strongest, lightest.
Strongest, but also most efficient. Often companies use too much cardboard. They overspec the box just to be safe, adding weight and cost. Paper 2 Box calculates the absolute minimum amount of fiber necessary to get the required strength to survive the specific journey that product will take.
So it saves material. It makes the box lighter.
Which saves the customer money on materials and shipping. And it's a huge sustainability play. We can give you the same strength to protection with 10% less paper.
Less waste. Better for the planet, better for the bottom line.
Less waste. And the result of all this high-tech wizardry, the company says they're winning nearly 50% of new business pitches where they use these tools.
50%. That is an incredibly high hit rate in a competitive industrial industry. Usually you're happy if you win 1 in 3 or 1 in 4.
It creates stickiness. Once a customer optimizes their supply chain and their marketing around Smurfit's data and designs, it's very hard to switch to a competitor just to save a few pennies on a box. You become embedded in their business. It builds a real moat.
Okay, so we have the turnaround, the culture, and the tech moat. But here is where it gets really juicy for the financial types listening. Section 6, the free option. This is the pricing story.
This is the part of the story that isn't fully in the stock price yet. This is the hidden lever, the potential upside that the market is still skeptical about.
So let's look at the guidance. Smurfit Westrock gave guidance for 2026. They said they expect adjusted EBITDA to be between $5.0 and $5.3 billion.
Right. That is their official forecast. That's what they've committed to.
But, and this is a huge but, that guidance is based on current market conditions. It explicitly excludes any benefit from upcoming price hikes.
It assumes prices stay flat for the rest of the year. It assumes the world doesn't change from this very moment. It's a conservative base case.
But the world is changing as we speak. Enter the Cascades signal.
Cascades is a competitor in the industry, a smaller player, but a significant one. They just came out and announced a $70 per ton price increase for containerboard, effective March 2, 2026.
$70 per ton, is that a lot in this space?
It's very significant. In this industry, margins are made on the margins. A $70 hike on a product that sells for, say, $1,000 a ton is a 7% price increase. That's a major move. And Truist Securities released a report saying this is a positive sign for the whole industry. International Paper, Packaging Corps of America, and of course, Smurfit Westrock. The expectation is that everyone will follow.
Why now? Is demand suddenly skyrocketing? Is everyone suddenly buying 50% more stuff online?
No. It's less about demand skyrocketing and more about supply shrinking. We're in what some are calling a containerboard renaissance. The industry as a whole has removed about 10% of capacity over the last year or so.
That's the sledgehammer to supply we read about. It's not just Smurfit, it's the whole industry closing their old, inefficient mills.
Exactly. Producers got tired of low prices and poor returns, so they shut down mills, they disciplined themselves. Now, operating rates, the percentage of time the mills are actually running, are pushing toward 93%.
93% operating rate. Explain what that means for pricing power. What does that feel like?
When you hit 93%, the mills are basically full. There is no slack in the system. If a customer calls and says, I need an extra 100 tons of paper, you can't just spin up another machine. So pricing power shifts dramatically back to the producer. If a customer refuses a price hike, the producer can say, okay, good luck finding paper somewhere else, there isn't any.
So the customer has no choice. They have to pay.
They have to pay if they want to ship their products.
So let's do the math on this free option. If this $70 ton hike sticks and everyone follows...
We have to talk about operating leverage. This is a key financial concept.
Okay, define that for us.
Operating leverage means that since your fixed costs, your factory rent, your salaried staff are already paid for, any extra revenue from a price hike flows almost directly to the bottom line. It's nearly pure profit.
So if they sell the same amount of paper, but for $70 more per ton, that extra $70 is almost all profit.
That's right. And that could add hundreds of millions of dollars to Smurfit's bottom line on top of their $5.3 billion guidance. Some analysts think it could be $600 million, maybe even $800 million, depending on how much volume they have and how quickly the price flows through.
So the official guidance is $5.3 billion, but the reality could be closer to $6 billion or even more.
Exactly. And the market isn't pricing that in yet. That's why we call it a free option. You pay for the stock today based on the conservative restructuring story, the fixing the garage story, but you might get the massive pricing boom for free if it materializes.
That is a compelling setup. It's heads I win, tails I, well, not lose, but I still win a little bit.
Exactly. It provides a margin of safety for the investment, a powerful upside catalyst.
Now let's look further out. Section 7, the 2030 medium-term plan. Management isn't just looking at next quarter, they're looking at the next 5 years. What are the big, audacious targets?
They are ambitious, but they laid out a clear path. They're targeting adjusted EBITDA of roughly $7 billion by 2030. That's a 7% compound annual growth rate from here.
And they want to expand those margins up to 19%.
Up about 300 basis points from where they are now. That confirms the value over volume strategy is the long-term play. They're not going back to the old ways.
But the number that really popped out to me, and I think popped out to a lot of dividend and income investors, was the cash flow projection.
The cash harvest, as they called it.
It sounds like a farming term, very agricultural.
It kind of is. They planted the seeds with the merger and the restructuring, and now they are projecting they'll be harvesting the cash. They expect cumulative discretionary free cash flow of $14 billion through 2030.
$14 billion. That is a mountain of cash. That is more than the GDP of some small countries. What are they going to do with it? Are they going to build a golden palace?
Less unlikely, knowing this management team. They're going to give a lot of it back to the shareholders. They have a very clear capital allocation plan. They plan to return $5 billion of that directly via dividends.
$5 billion. Wow.
And they've already started. They just raised the dividend 5% to about $0.45 per quarter. At today's stock price, that's a yield of roughly 4%.
That's a healthy yield. In this market, that's very attractive. And what about buybacks?
Share buybacks are authorized to begin starting in 2027.
Why not now? Why wait a year?
Because 2026 is the year of the fix. They need the cash on hand to execute the restructuring, closing the mills, paying the severance, optimizing the plants. Once that heavy lifting is done in 2026, the buyback engine turns on in 2027, which will provide another tailwind for the stock.
And usually in these big mergers, companies promise synergies, cost savings that never quite materialize. You hear them say, we'll save $1 billion, and then a year later they've saved $10.
It happens all the time. It's one of the biggest risks in M&A. But Smurfit Westrock is ahead of schedule. They've already exceeded the $400 million synergy target they set for themselves.
So they are cutting costs faster than they promised.
Which builds credibility with the market. When management says, we're going to hit $7 billion in EBITDA by 2030, the market is more likely to listen because they already over-delivered on the synergy promise. They have earned the benefit of the doubt.
Okay, we've covered a lot of ground. We've covered the disaster earnings that weren't really a disaster. We've covered the owner-operator culture shift. We've covered the hidden upside from the $70 price hike. Let's head to the outro and summarize this whole thing. What is the final verdict on Smurfit Westrock?
The verdict, in our view, is that Smurfit Westrock is a high-yield self-help buy.
Okay, break that down for us.
High yield because of the 4% dividend and the massive predictable cash flow coming down the pipe, and self-help because they're fixing their own problems in North America. They aren't just sitting around waiting for the economy to save them.
They are active, not passive. They're controlling their own destiny.
Exactly. And this powerful self-help story is masked by a cyclical recovery in their industry. The self-help part is the cake. The pricing recovery, that $70 hike, is the icing. You get both.
But we have to be balanced here. We can't just be cheerleaders. What are the risks? What could go wrong? What keeps Tony Smurfit up at night?
There are two main things, I think. First is execution risk. Can they actually replace that 1.2 billion square meters of volume with high-quality business?
Right. It's one thing to say, we'll find better customers. It's another thing to actually go out and sign the contracts and ramp up that new business.
If they threw out the old customers but can't find enough new ones, then they just shrink the company for nothing. Then you just have a smaller company with a high overhead base. That is the danger zone. That's risk number one.
And the second risk?
It's the one you can't control. Macro risk, the economy.
The big, bad recession that's always lurking around the corner.
If the global economy tanks,
Mm-hmm.
if we go into a deep, prolonged recession, demand for boxes falls, period. It doesn't matter how good your strategy is or how smart your AI is. If people aren't buying TVs and refrigerators and avocados, they don't need boxes.
The rising tide lifts all boats, but a drained ocean strands everyone, no matter how well built the boat is.
Well put. But even in that scenario, Smurfit would argue they are risk-defined, portfolio protected, because their business is essential. People still buy toothpaste and food and medicine in a recession.
Right. We always need boxes for something. Maybe fewer big TV boxes, but plenty of mac and cheese boxes.
Exactly. The business is defensive, even if it's cyclical.
So here's the closing thought for you listening. We talked a lot today about value over volume. Smurfit Westrock took a hard look at their business and realized that being busy wasn't the same as being profitable. They took the hit, they shut down the machines, and they focused on what actually creates long-term value.
It raises a fascinating question for our own lives and our own careers, doesn't it?
It really does. I was thinking about that. In your own work or your own business, are you chasing volume? Are you just trying to be busy? Answering every email within seconds, taking every meeting, chasing every lead just to feel productive?
Or are you chasing value? Sometimes the most valuable thing you could do is fire a client. Sometimes you have to say no to a project that isn't the right fit. Sometimes you have to take that economic downtime, take a break, reset, learn a new skill so you can run more efficiently and more profitably later.
Smurfit Westrock chose value. They took the heat in Q4 and the market applauded them for it. Maybe there is a lesson in there for all of us.
I think there definitely is. Quality over quantity, always. It's a harder path, but it's usually the right one.
Thanks for diving deep into Griffonomics with us. We will see you next time.
Bye, everyone.